Well, good morning. It feels like it's been weeks since we've been together.
I know.
We just weren't sitting next to each other this week.
Right.
And of course, I was in a hotel, and hotel Wi-Fi's are always fantastically dependable.
Kind of crashed there at the end. Not a soft landing. Like
It was not a
Federal
soft-
Reserve.
No, we had a hard landing last week. But here we are. We're doing it again. We're right next to each other. We're not on Wi-Fi today. We're on the land. So everything, I better knock on some wood. But very excited to be here. I think there are more questions than answers.
Yeah,
You just had Mark Fleming in yesterday.
I did. So our chief economist with First American Title, nationally recognized speaker. He speaks for CNBC, CNN.
I mean, he's
all
amazing.
of the major outlets came in yesterday and gave a talk to about 200 real estate professionals inside of a movie theater.
Yes, that's right.
Yes. So I had the biggest PowerPoint presentation I've ever had.
Just a massive screen.
Just a massive screen,
Yes.
massive screen, great information.
Yeah.
Interesting to hear what his take is on everything. And
Yeah.
so we will have a recording for that I'll be sending out next week in case you missed it.
I know. I was like, and I wanted to be there so bad. And it was a packed room. So super excited.
Yes.
Mark's fantastic. Can't wait for the recording of that to come out. Guys, this is the time where we just have to stay focused on the client conversation, their emotion. I was talking to a group 2 days ago. I was out of the office yesterday for cortisone shots.
Mhm.
Damn my back. But talking to a group a couple of days ago, and even just talking about the fact that right now we have more stress in our marketplace. So people keep talking about the fact that sellers are locked in. And I don't know how much sellers are locked into the interest rate. They're locked into that security of a low monthly payment, right? That comes with the low interest rate. But it's a security against all the instability that's out in the marketplace right now, right?
Yeah. People tend to freeze when they get under stress.
Yes.
They freeze and they don't want to do anything about it.
And Mark was even saying, as we were talking about before, that there might even be a double dip
Recession.
Housing recession. So, all of these things, it's like what to do. So that's my quote this morning is super simple. And it actually was inspired by an agent that I saw on Facebook. She said I could share the story, but it's just as simple as be good, do good. And it resonated with me right now because every conversation's not going to turn into a transaction. It's easier to convince somebody to get out of a 3% interest rate than it is to get them off and out of fear, right? Yeah. And so I can convince somebody with debt consolidation opportunities, with a better home, with opportunities for greater appreciation in a different market. I mean, you could go into all the statistics on why it's better to move from a 3% to a 6%, as hard as that may seem. It's harder to get somebody out of fear. So just to be with someone and to help them through those emotions, whether it's helping somebody that just had the death of a spouse, which happened to be this story on Facebook, which I won't go into because it's a longer story, but being there for that woman who needed just comfort and needed guidance, or being there for the first time home buyer who's freaked out and scared, and just being their partner and their companion in this journey over the next year while they figure it out. It's all of those things. So be good, do good.
I like that.
Yeah.
I think the world needs to be a little bit kinder. I was driving in traffic. So I went to a mastermind group that I participate in every month with a group of top producing agents. We were all at a listing that we were trying to figure out the pricing on. So it was just kind of a funky listing.
Yes.
And I had to go from there into Rhino. And so I had to drive kind of a funky way through town in order to get from the Highlands into Rhino. And I got cut off by like 5 people. And I was like, what is going on?
Oh my goodness.
What is going on?
Did you hear
People
the
are so angry.
shooting on I-25?
Yeah.
That shut down I-25?
Yeah.
We definitely need to be kinder.
Yeah.
Yes. And this is the season. It might not be the season for a closed transaction. And it just might be the season to grow your database and be relevant and stay in communication and stay in flow with your clients. That's all we're doing.
Just hug your friends. Hug your friends. With that said, we'll go ahead and hop into the weekly data for you guys. I do have one number that showed up a little bit funky. I'm not quite sure what is going on with it, but I'm going to pop in and I'm going to point out the number, and then I'm going to double check everything before I go into the presentation. But this covers the week of June 7th through June 13th. And so this is just this last week of data, no holidays this weekend. And so interestingly enough, I wanted to see the market pick up a little bit more than it did,
Yes.
but it didn't quite rebound. So we're not seeing spring numbers like what we were seeing back in March and April, but it's still not bad. Overall, we're still beating out our baselines from 2013 through 2019 in terms of the odds of selling and days on market and all of those other metrics that I go through and track, but it's again, we're dealing with this kind of weird diametric blah, 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 blah.
Yeah, that.
Yes. Yes. I can't tell if I've had too much coffee or not enough.
You were up early this morning.
I was up at 4 this morning.
Yes.
Yeah, I was up at 4 the last 2 mornings in a row. I'll be up at 4 tomorrow morning for a swim meet.
Oh gosh.
Yeah.
They shouldn't be swimming that early.
I don't have kids this weekend, so I will be sleeping in on this weekend.
I don't know how a kid gets up at 4. What time are they getting up?
So they're getting up at 5:30.
Okay.
Yeah.
That
But I
makes
have to be up for an hour before the kids get up. So
I was
also
always
my
that way
time
too.
Where I'm like, I have to get into the mindset of being a mom. So I have to be up early,
Yes.
have my coffee ready to go. And I'm a much better parent when I get that hour to myself in the morning.
100%. I used
Yeah.
to go to the gym every morning at 5 a.m.
Yeah.
I'd sneak out, go to the gym, get back. They never knew I was gone.
Yeah.
Yes.
That's perfect. And so we're dealing with this weird, it's dichotomy is the word that I was trying to use.
That's a good word.
That's a good word. In the marketplace where sellers think that it's 2022 and
Yes.
buyers think that it's 2008. And it's so important that you guys are in touch with what's happening in the data so that you understand what's happening and how to explain what's happening in the marketplace right now. Because what we're feeling from the media is the media is going through and saying that home prices are falling. And that's true that they're down from where we were 1 year ago by about 2.5% to 3%. But month over month since February, home prices have been going up.
Yeah. Yeah, we hit the bottom in February.
Yeah. And so right now our home prices have gone up nearly 10% just so far this year. It's not enough to catch the highs that we saw in 2022, but it's not bad.
No,
it's not bad.
And it's interesting though, when you talk about this dichotomy, it's dependent on, as you talk about when you show the map, it also depends on where you are, because some of them are feeling not that it's 2008, but it's closer to that end of the spectrum than it is 2012. And some neighborhoods are definitely feeling closer on the spectrum to 2012.
Yeah.
So you've got this even within the same metro.
Yes.
Right.
Yeah.
So it's so hard
really
to figure
depends.
out what to do.
It really depends. And so again, all of your talking points are in the weekly highlight reel on slide 2. I'll let you guys take a look at that when you have a chance. Looking at all prices again, going back to our heat map and our strategy sheets. Keep in mind that our best selling months, there's our target listing month across the top and based on average days on market and time from contract to closing. These are your target closing month, but really the best time to be in the market as a seller is March, April, and May. And as we get into June, listing in June, closing in July, our inventory starts to rise, our pending transaction count starts to fall, closed count starts to taper off. We see more expired listings in the marketplace. The odds of selling starts to drop off. Percent of closed to list price ratio still remains pretty high, but it ends up going down just a little bit as we get further into the summer months. Days on market starts to increase. We start to see fewer units going under contract in 7 days or less. Our month supply of inventory starts to creep up, and I can't see around the microphone. We see more reduced listings, bigger price reductions, and the percent change in average sales price starts to go down.
That's pretty significant.
It's really important that you guys are paying attention to your pricing strategy because you cannot price it like you could back in March, April, and May based off of those comps. You really have to pull back on that average price by about 1% right now based off of the listings that are being listed right now in June, hopefully closing in July.
Yeah.
Now, again, we've got July 4th coming up. Well, we've got Father's Day weekend this weekend.
We do.
And so typically we see about a 10%.
And it's Juneteenth.
And it's Juneteenth.
Yes.
And so I don't have great data around Juneteenth. It's such a new 3-day holiday weekend and not everyone takes it off.
Right.
At the title company, we're closed. Are you closed?
My office is closed, but I'm working. I have a bunch of DMAR's got a couple meetings going on. I've got some realtor calls going on.
Okay.
Yeah. So I'm working.
You're working. Okay. So we're closed.
Yeah.
And so we won't be having, but Federal Reserve is closed. So we can't do
The
any
banks are
wires.
closed. That's right.
So, but it's important that you guys understand that could take a chunk out of this weekend. So you might expect lower showing activity this weekend.
Yeah.
So it may not be the greatest weekend to hold an open house. You might not get as many showings coming through. We may see fewer contracts coming in as we go into this next weekend. So historically, Father's Day has taken about 10% off the market in terms of showing activity and pending transaction counts. And then usually Juneteenth, I don't remember what I did last year. I'll have to go back and month.
we only have the 1 year.
Yeah.
So it's hard to,
Yeah.
although talking about open houses, we've got a couple on our docket. So I'm super excited. The Ruth team is starting to do open houses with the agents that we work with. So if you're doing them and you want a lender to come join you, give us a call.
Awesome.
Yeah.
So looking at our strategy sheets as we track this on a weekly basis for you now, the best weekend to list in based off of data so far this year would have been the weekend directly following Easter weekend with a 66.8% odds of selling. Now that number has cooled. We're now sitting at about 59.3% odds of selling. So it's continued to decline. It's likely to continue to decline through the end of the year. So if you have listings that are coming up and they're toying with when do they want to list, my advice to you is to get it to market as soon as you possibly can, because our buyer pool continues to taper off and we go through this interesting shift of retraction. And I think that we're already in the retraction phase right now, starting as of this last week or two. And it took a week or two to get the data in to see what was really happening, but inventory started to bolt up. Not huge, but it's going up.
But every little bit counts.
Every little bit counts right now, but pending transaction count had started to go down. And so overall, the market is shifting between that relationship of supply and demand that causes that shift in prices, and it changes the dynamic of the overall transaction.
Now, interestingly, though, and I'll show the chart, mortgage purchase applications are actually up 8%.
They're up 8%.
This last week.
That's great.
So it could just be one of those week on, week offs as the interest rates shift.
All right. And so, you know, it's been interesting, and we'll look at showing activity and stuff. And we had 2 Nuggets games over this time frame on Friday night and on Sunday night.
And the parade's today.
And the parade is today. So
I had several people go, parade, Megan and Nicole.
I know. How many people were on the call? We got one night. We're a little bit low in the number of people that are on this call today. I had 700 people register. We've got about 200 online right now. So yeah, go Nuggets. Congratulations to them, but you're taking a chunk out of my time right now. And so our average daily active count ended up being just shy of about 5,000 active units for sale. And that went up by 4.8% week over week. New listings this week were down by about 0.6%. We're still down 25% in terms of new listing inventory making its way to market this year compared to the same week 1 year ago. We've been consistently down 25 to 30% in terms of new listing activity coming into our market. Again, we have interest rate gridlock that's taken a hold of a lot of people, where the people that are moving this year are the people that have to move and not the people that want to move.
So do you have that new listing compared to 2019? I think it's still low, like significant, even lower than 25%.
Yes.
So our inventory is down even from our good years.
Usually at this time of year, we have about we usually have somewhere between 7,500 to 8,500 available homes for sale.
Wow. That's a difference.
Between the two, we have about 5,000. And so again, it's really low. Withdrawals went down this last week by 18.4%. Back on markets were down 5.5%. I think we worked through a lot of the listings that had flooding that came back on market a while ago when those numbers were spiking. Closed transactions were down this week by 29.3%. Again, we start to see more closed transactions in the last week of the month. We close about 30% of all of the transactions in the last week of the month. So we end up seeing that number spike as we get towards the end of the month. Month supply of inventory came in at 1.1 months worth of inventory, cooling from the 1 month of inventory that we had just last week. Over Memorial Weekend, it was 1.3. And the couple weekends before that, we were sitting at 1.0 months worth of inventory. So that's been on the rise as well. That number, I expect it to go up probably another 10th as we get into next week, as people start to take the weekend off for Juneteenth and Father's Day weekend. The odds of selling cooled this week by 2.3% to 59.3%. That's still higher and better than what we typically see for the month of June. Historically, in June, we see about a 58.5% odds of selling. So we're still a little bit higher than where we have benchmarked in the past for the month of June. Looking at where we are for percent of balance based off of what went under contract last week, we would need to have about 28,000 total listings available for sale. So we're currently only sitting at 17.5% of a balanced market. There's still appetite out there for homes. It's just, what are they buying?
Right.
Yes. And so looking at where we were for showings ended up falling by about 1%. We'll call that flat, but it was about 13,846 total showings that were set last week. So that meant you should have gotten 2.8 shows per property per week. And so if you didn't get your 2 or 3 showings in, that may mean that you don't have your listing priced appropriately, and you may need to pull back in your original asking price. Conversely, they actually looked at 1 less property this week than they did last week. It dropped from 14 shows to contract down to 13 shows to contract. So the people that were out there that were looking were a little bit more serious this weekend, and they put stuff under contract. Looking at where we were for median days on market over Memorial Day weekend, we popped up to 9. Last week was 7. Now we're back up to 8. Median days on market tends to grow as we start to get deeper into the summer months.
Yes.
And so expect there to be a little bit more time on market as we get deeper into. I really hope that we don't start to see this again as we go into the winter months for median days on market, because those are some really challenging and stressful days weeks that we were looking at in terms of how long it was taking to sell properties. Again, there was a little bit of a conversation yesterday with Mark Fleming about a double dip recession that could be coming in Q3 if we go into a recession. He's not hopeful that rates are going to drop this year because Powell came out and said that they're going to hold it flat for now, but there are likely 2 more increases coming up this year. And so that could force the double dip recession that we've been talking about.
So many people have been holding their breath, including me, right? We all wanted it, and we thought the second half of the year was going to be so much better when we saw, and it wasn't like this massive spike, but we thought maybe the spring would get elongated and we'd have that greater volume throughout the year. I don't know that I see it anymore.
No.
Like, I really do think that it's going to be next spring before we see the opportunity for lower interest rates, but that does continue to offer opportunities for buyers getting in with VA loans, FHA loans, down payment assistance loans. I mean, you have to continue to talk to the opportunity and speak into the people who are listening and ready for the opportunity.
Yes, absolutely. Looking at where we were for price reductions this week, it was of the units that went under contract this week, there were about 28.8% of them made price reductions. 61.9% made no change whatsoever. Average price reduction was about 5.2% off of the original price, or about $42,000 off of that original listing price. For homes up to 500, and this is where I think my typo comes in, because look at this. All of a sudden in my strategy sheet, it turned super blue across the bottom there. And I think my pending transaction count is off. So I'm going to go through and check that. And so our average daily active count went up by 8.6% this last week. So lots of new listings that were under $500,000. New listings on the market were down, were 373 listings on the market. Back on market were 87. Expireds were down by 53%. No change in withdrawals. Pending transaction count, though, this number throws me through a loop. I don't think that number's right.
You think it's too low?
I think it's too low. I think I typoed something. And so we had 238 units go under contract, which made our month supply of inventory jump from 0.6 months worth of inventory up to 1 month of inventory. So I'm going to fact check that one before I send out any of the reports today. So I'll make sure that I've got a corrected version for you, but interesting shift in that particular market. The odds of selling was 61.7%. That's down from the 70% that we saw the last week. So that's a big jump. And so I think that pending transaction count is throwing that number off in there too. This a number of balance. So we went from 10.1% of balance up to 17.4% of balance. So I think that number's off too. Shows to contracts, we were looking at about 4.4 shows per property per week. That one doesn't seem off. That seems on that number is correct. But then looking at shows to contract jumped up to 20.2. And so again, I think that number is off just because of my pending transaction count being so low. And so looking at where we were for median days on market, we were looking at 7 median days on market, 6 to 7, going from last week, and 20.6% of all the homes reduced their price with an average price reduction of about 4%. The price reduction ended up going down by 1.3%. So it was a lot lower this week, with about a $16,000 price reduction overall for homes up to $500,000. For 500 to $1 million, these numbers are all correct. I'm confident in these numbers. But here's our strategy sheet.
It'd be really interesting if that number is correct, though.
I know. They were really big Nuggets fans for those buyers. $500,000. They were really focused on watching the Nuggets. Really focused on that.
Or there are a lot of investors too that are holding back.
Yeah, maybe. And so here's our strategy sheet. You can see the cooling trend really settle in back here in April, right after Easter weekend. We ended up popping up to a 66.2% odds of selling. Now we're down to a 60% odds of selling. So we're not too far off from where we were previously, but it has definitely slid and it started to cool in the marketplace, indicating retraction. Looking at our average daily active count continues to grow, as it will likely to continue to grow into September. Average daily active count was up by 3%, with 2,700 to 2,800 total listings that were available for sale. New listing activity was up by 7% this week for homes between 500 to $1 million. So more inventory coming in. We ended up seeing our pending transaction count go up by 4.3%. So some nice activity there based off of what we saw just the last weekend, making our month supply of inventory about 1 month worth of inventory for homes between 500 to $1 million right now. Odds of selling declined again week over week by about 2.6%. We're only off by 8.2% from where we were 1 year ago, which I thought was interesting. I was like, that's not too far off.
No.
Even working with a 7% interest rate right now, that's not too shabby. I'll take it. But we had about a 60% odds of selling if you listed last week in the next 30-day period. Looking at where we are for balance, we had 17.3% of a balanced market. We would need to have around 16,000 total listings available for sale in this market in order to satiate demand. We were looking at about 12 showings to go under contract. So that number dropped here as well. And so looking at where we were for shows to contracts, looking at 12 shows to contracts, going down from the previous week. We were at 9 median days on market. That number is held consistent over Memorial weekend. We were up to 12, but it's been hovering around 8 or 9 now for about the last 30 to 35 days. Price reductions are on the rise. We saw a 3.4% increase in the number of units that made a price reduction at 33.2%, reducing their price, with an average price reduction going from 4.7% up to a 5.3% price reduction, or $41,000 off of their original asking price.
And that's where you were kind of saying we're starting to see a shift.
Yeah.
Right. People are already starting to come down from what they want.
Yeah. They are.
Yeah.
They're definitely starting to come down. 1 to 1.5 million. Again, this only represents about 7.6% of our overall inventory. Just like what we saw with the other property reports, the market starts to cool, especially as we get into June and early July. Late July really calms down as we get into this $1 to $1.5 million presentation. And so again, looking at how much that cools off as we start to get later into the summer months, these people are vacationing in the luxury price points. They're not out shopping for homes. They are much more likely to shop for homes in March and April being our hottest month overall, but getting into June, July, and late July, it really starts to cool down. Here's our strategy sheet for the week. Again, we peaked out and was actually right at the beginning of April. So the weekend before Easter was our hottest month, where we had a 57.6% odds of selling. Now we're down to a 51.8% odds of selling. Overall, looking at this market, average daily active count in this market rose by 6.4%, but not due to new listings, due to listings sitting on the market. Interesting.
Yeah.
So new listings were down by 0.8%, with 122 new listings making their way to market. Back on markets were down, expireds were down, withdrawals were down. Pending transaction count actually rose by 12.1% to 74, making our month supply of inventory drop from 1.7 down to 1.6 months worth of overall inventory. So this is still considered to be a deep seller's market with less than 2 months worth of inventory in our marketplace. Looking at where we were for the odds of selling, it actually went up week over week by 2.4% to 51.8%. Percent of balance at 17.9% of balance. That declined by about 1% this last week. We should have just under 2,900 total available units for sale in order to offset demand. We were looking at about 2.1 shows per property per week. So if you're not getting your 2.1 shows per property per week, maybe time to consider that price reduction.
Can you see like how slow that would seem to a seller?
Yes.
I had 2 showings this week.
Yeah.
Right. But if that's all it
it's
takes.
Interesting.
Yeah.
I had a client call me who had a listing at 1.2 in Sloan's Lake.
Yes.
And she said, my sellers are in a panic. They only got 3 showings this last weekend.
Yes.
And so I pulled up the showing time report, the target market analysis for that price range and that zip code. And I was like, that's what's going on out there right now. Is you've got about 3 showings per property per week. And so
it takes 15 contracts to get
15 showings to
get
go
them.
under contract. Yeah. So it's about 15 showings to go under contract. That was down from the previous week at 16.8. So buyers got more serious this last weekend, dropping the number of properties they look at by 2. We were at 7 median days on market this last week. So it went from 6.5 to 7 over Memorial Day weekend. We were at 13, 11 the weekend before that. So keep that in mind as we get into these holiday and 3-day weekends where people are taking that time off. 33% of everything that went under contract last week had a price reduction. 66.7% remained unchanged. We saw about a 6.8% price reduction, or about $96,000 off of their original asking price. 1.5 to 2 million. This is the last one that I can reasonably track on a weekly basis, because once you go over $2 million, there's only a handful of those transactions going under.
Because it wouldn't even be 1%.
No, it's not even 1%. Best month to list in historically, March for this $1.5 to $2 million price point. April still looks pretty good, but you can see getting into early May, late May, and June really starting to cool off as we get into these next couple of days. Looking at where we are for our heat map for this week, cooling trend really settling in. Best week to list would have been that weekend directly following Easter weekend with a 53.2% odds of selling. Now we're down to 41.6% odds of selling. Looking at just this last week, we went from 2.2 months worth of inventory up to 3 months worth of inventory, because our pending transaction count fell by 25.9% week over week, with only 20 units coming on the market. Our average daily active count was only up by 1.2%, 10.2% fewer new listings made their way to market. Back on markets was at 14.3% increase from where we saw last week. Expireds and withdrawals are down. Odds of selling, we've already talked about this a little bit, but it was a 41.6% odds of selling overall this last week, which fell by 1.8%. Likely to continue to decline through the end of the year. Where we are in terms of balance, we're now sitting at 24.6% of a balanced market for 1.5 to 2 million. You're looking at about 1.5 shows per property per week. So if you didn't get your 1.5 showings in, I don't know how you get a half a show. They only look at half of the house, or just maybe just the wife is there, not the husband is a half a show.
She's going to bring him next weekend.
Yeah, right, right. They were looking at 19.9 properties before going under contract. So it went from 13 shows to go under contract up to 19.9 this week. Of the units that went under contract last week, they were on the market for a median of 10 days. That was down from 14, which was what we saw last week. 31.6% of them reduced their price, with an average price reduction of 10.3% this week. So 212,000 price reduction overall. And so I'll escape out of this and stop the share. We've got some questions, so I want to make sure that I leave time for that. I've got 4 minutes to get through the questions. So what percentage drop in showings we should typically see for Father's Day? Usually it's about 10% for Mother's Day and Father's Day overall. With all things so wonky in the market and buyers being more savvy, etc., does some of the historic stats such as Father's Day affect open houses, or the patterns they have really have an impact? Again, traditionally, I think yes, but now in this odd market. And so, yes, I still think it's going to be down by about 10 to 15% this weekend. Yeah. Even with a 3-day holiday weekend, I think it's going to be a little bit wacky this next weekend,
depending on how many people camping.
Could be, yeah.
If this rain,
July 4th is on a Tuesday this year. Would you just wait until July 14th to list? I think that if you can get it to market the weekend before July 4th, because with July 4th being on a Tuesday this year, that doesn't mean 3-day weekend. That means 4-day weekend. Right. People are going to take Monday off, and First American is actually closing on that day because we didn't have any closings that were scheduled for that day.
Really? On the 3rd?
On the 3rd.
Yeah.
And so people are trying to push their closings earlier. I would try and list it at the end of June rather than waiting until July.
Really?
Because there's a really big drop off in showing activity as we get after July 4th weekend. Do you feel like the DOM peak last year was on pace with rate increases? Yes. Yeah, very much so. I do. Where it ended up killing a lot of our buyer pool, and it caused so much uneasiness in the marketplace that people really pulled back in that.
And you got to think this time last year, the rates weren't nearly even as high as they are now. It was the fear factor, right? It's so much is driven around fear and emotion.
Right. Can you repeat the percentage of homes that had a price reduction in the non-luxury price market? It was about 25.8% for homes that were under $1 million. That ended up making a price reduction. Showing activity for 500 to $1 million was about 2.3 shows per property per week. And it was 14 showings to go under contract. Is that right? Oh, 13 or 14 showings to go under contract. And I'll be sure to send out the presentation to you guys shortly. And so, do you have a buy before you sell program? If so, please call me.
Hey, Sandy, it might be easier for you to call me. I have to write down the number. But yes, we do have a buy before you sell program.
I'll just leave that up there.
Yeah.
We got a thank you with a listing that's priced slightly under market value, getting a lot of showings and good feedback, but no offers. Do you recommend a price reduction or wait it out? It depends on how long you've been on the market and how many showings you've received. And so if you've only been on the market for 1 week or 2 weekends, I would probably wait until weekend number 3 to go through and make that price reduction. 20 days and 40 showings. I would say, what price is the property at?
See how fast you can type.
Yeah, 600K. Yes, I would say that it's probably time to go through and make a price reduction at this point on that property if you've had that much showing activity and no offers on it.
Yeah.
That takes us through all of the questions. I'm going to leave this one up here.
I got it.
So, okay, cool. So we're done and we will turn it over to Nicole for her presentation.
Well, you guys, this week was really fun. I'm just going to say it because it was crazy. We had tons of activity in all different directions and leaving bond investors as well as stock investors really questioning which way they're going to take the market. And the stock market is celebrating things that the bond market isn't. So we're going to talk all about that. Let me get my screen share going here really quickly and then we can do it. Do that one. Or not. Or yes. Okay, there we go. All right. So you guys, we'll double click on this, right? Just be a good human in all of this. I really do think Megan and I were talking about this morning, that right now, some of you are having fantastic years, right? Because you're in flow with your clients. Some of you are wondering when the crickets came out and when they're going to go away. And some of you are just doing your thing. And so in this kind of market, we're staying really active with both of our real estate agents and our clients, and it's producing results, hands down. It's producing results. We're doing a lot better than a lot of other lender teams out there. But what I am finding is the moment we start to try to pressure somebody or start to even hound them too much, they start to pull back because of this fear being so big. So we're just leaning in and letting them know that we care, that it's deeply passionate to us to get them into a home, whether it's credit repair, whether it's a soft pull on their credit report, whether it's just running numbers for them on a regular basis until they start to feel comfortable with it, whatever that is. And then introducing them to the CPA, the financial planner, to the A team that gives them that sense of comfort, right? So being in flow with your clients is so critical right now. All right. So one of the studies that came out this last week was really quite fantastic, not fantastic in a good way, like phenomenal in a big way. 64% of Americans say that they're waiting on the sidelines for interest rates to drop. I want us to really settle in with that number for a second. 64% of the possible buyers are sitting on the sidelines waiting for interest rates to drop. But what's gonna happen as soon as interest rates drop?
Yeah, we're gonna go back into that crazy economy again.
Wow, crazy. It is gonna be a frenzy. And I know the economy is slowing down, and we're gonna show some of those numbers. And so people are pulling back, and there is some fear, and some people are getting laid off or losing some of their income. But there's a lot of people at the wealthy end that are getting super wealthy right now. So if you invested in some of the IT or AI stocks, you're doing really well. So there's a lot of wealth that is going to pour back into the real estate market as soon as people feel confident with where the real estate market is. 64% sitting on the sidelines. That's a massive number. So, whoops, sorry. I get so excited. 64% are sitting on the sidelines waiting for mortgage rates to drop. I want to show how intensely tiny this little drop is. So this little drop right here is the reason that Diane Olick went online talking about the fact that we saw an 8% jump in mortgage purchase applications because we saw interest rates drop like less than an eighth 2 weeks in a row. So and we actually tipped up to 7% yesterday. They came down a little bit today, but still this little drop and this little drop right before it. So that is all people are waiting on. Have they gotten used to an interest rate in the sixes, or are they really dialed into the fact of knowing that when the interest rates do drop, I am going to see an uptick in demand. We are going to see home prices accelerate because we're going to see any good home gobbled up and we're going to have to pay for it. I mean, you can see that just in all of the previous rises and falls. So if I had a drop in interest rates in February, we all had a pretty good month in March. In fact, we would say that it might have been the height of the season.
March was great. April was weird.
April was weird because look at the interest rates right before that. In March, the interest rates topped out. So April wasn't so good. Then April, the rates went down again, and May was good.
Yeah.
Very interest rate centric right now. Right. And so when I saw that mortgage purchase applications jumped 8% on this, I was like, okay, we don't even care. They dropped like that. I just need that headline and people are going to go out and buy. So that's kind of interesting and really just a measure of there are buyers out there who want to get that deal. They're going to be like, oh my gosh, it's an eighth better. It's a quarter better. Let's go ahead and lock it in. We know interest rates are going to fall. It's just a matter of when, and it's going to be longer than we thought. That's the problem, right? But opportunity. Here's the other survey that was pushed out. 29 million Gen Zers have a goal to buy by 2026. 29 million Gen Zers. That is a massive number. That doesn't even include the swell of buyers, the 63% of them who are actively looking to buy now. We're sitting on the sidelines. Add to that the 29 million, because remember the previous we talked about when the millennials finally hit the 50% home ownership rate was at the exact same time that the adult Gen Zers, the oldest Gen Zers are 25 right now because I have one. The oldest Gen Zers are 25. The adult ones, the 21 to 25 of them, 50% of those are homeowners.
Wow.
They're already there. Right?
What?
They're anxious to do the thing that the millennials waited so long to do. So if I have 29 million, and not all of them will be able to buy, some of them will be able to rent, which is also an opportunity for investors. But these kinds of numbers absolutely should be in conversation and flow with you as you're talking to your prospective buyers. What happens if you wait till spring? What happens if you sign another 2-year lease and you wait another year? What is that market going to look like? And how is it going to affect the home that you're going to have to buy? So watching these kind of surveys and reading into them to not for just now, but what this means in the future. So right now, demand is down. In fact, I have to go all the way back to 2010 to see the same level of overall mortgage purchase applications. Now, you won't see this because the red line is so thick and it's the 4-week trend line, which is what we're really watching. But so, I mean, the 1 week jumped up 8%. It's kind of under there, but I have to go back to 2010. We had some really crazy COVID years, but what's not the same as 2010 is the inventory, right? That was 2010. You've seen that. I mean, if we don't have that inventory, and Megan's numbers, she's talking on a regular basis every single week of how low they are, that they're below 5,000 this week, that have that timeliness of information, then we're nowhere near the inventory that we had. So we're nowhere near the opportunity for a bubble. Now, could we see a second housing recession? Because what would that look like as far as percentage points, right? Did Mark throw out any numbers? No. Yeah. So even if we do see any price reductions, it's really going to be the people that bought most recently that are going to affect it, because everybody else has a massive swell of equity cushion baked into their homes right now. So only those that recently bought, and honestly, I'd buy, because even if I lost a little bit of that value, I got in and then can refinance and put myself into a better position before that swell picks up even again and takes away any of the loss almost immediately. National Homeowner Equity Report also came out this last week showing that Colorado is down an average of $23,000 in value per homeowner, right? So some a little more, some a little less. But I looked at that, I was like, all right, 23,000. I don't love that, but that's like a couple weeks. Well, that's like going to Italy, right? I mean, I don't know. Everything is in measure of Starbucks. It's like that's how many Starbucks coffees. But I mean, 23,000 is significant, especially to somebody who that is the greatest wealth that they have to their name, and which is your home is your greatest wealth for many people. But when I looked at that 23,000, when you actually dive into it, Denver has 1.6% of our homes in Denver are actually negative equity. And those are the homes that were purchased first quarter into the second quarter of last year. Everybody else before that had massive equity cushion, right? So you have a very few homes, less than 2% negative equity, really in a position. And here's a number. People keep talking about foreclosures ticking up and bankruptcies ticking up. Everything is in perspective. I was looking at retail sales numbers, headlines this morning. Retail sales are up. You know, consumers are crazy spending again. I was like, oh, did anybody actually look at the number? Or are we just, so we're going to show retail sales in just a minute. Perspective means everything. I mean, you show that in all of your charts. I love how long the timeline is because it shows that perspective, because one number compared to another number just back to back versus overall where that sits in a trend line. So we're coming up, and we are, but from down here at historic all-time lows, we're barely up. So those homes that are at risk, if you purchased a home with a VA loan or an FHA loan or a down payment assistance loan in the first quarter or the beginning of the second quarter, and your job moved you, or you did get you're in a job position where you were laid off, there are going to be people who are going to possibly be underwater and need to either short sale or foreclose. But those numbers are very small. They're not going to gain any opportunity, and it's not going to gain traction enough for a larger price reduction metro-wide, right? All right, so let's jump into what happened economically this week, because it was a big week. We had the CPI, we had Fed week. So core inflation, so this is what it was last month. It was 5.5%. And we were really talking, I spoke about this last week or even the week before, talking about that when this 0.63% rolls off, we will be replacing it probably with another 0.4, and that will drop us from 5.5 to 5.3. And that is exactly what happened. It dropped. It was another month over month of 0.4. It dropped core to 5.3 because the previous number rolled off, which really means inflation is sticky. It's been 0.4 for the last 6 weeks. It isn't moving very fast at all, which is what the Fed is watching. He's watching core, CPI, and PCE, which will come out in another couple of weeks. Now, the headline was sensational. In fact, both the bond market and the stock market celebrated for about an hour based on the headline number. And then we lost it all and more because we realized, this means that the Fed is not going to lower the Fed rate and might possibly not lower the Fed rate all year because core can't drop. It's just staying sticky. So we saw our headline drop all the way from 4.9 to 4%, certainly reason to celebrate, but the core just stayed pretty much the same at the 0.4, dropping it only because of the number last year that dropped off. So I talked about this on the Tuesday live. Push that out via the live via YouTube. So if you want to stay in the know, make sure that you're signing up for our YouTube channel. But one of the big reasons why we saw this Fed dot plot map change, which I'm going to talk about.
I have to giggle every time you say Fed dot plot map.
To say that Fed dot plot map. There you go. So let's talk about what this is. And this is what I was concerned about when I did the Tuesday, which was before Wednesday, the Tuesday live, talking about the fact that you've got a core that's staying sticky. The core right now is 5.3 on the CPI. The Fed rate is 5.1. That is actually stimulus, right? That's not contraction. So when you have the Fed rate needs to go above the core, and if the core is taking its sweet time coming down, the Fed is going to have to raise the Fed rate again. And last week we talked about the fact that Australia and Canada just raised their Fed rate. And last night overnight, the ECB just raised their Fed rate. So we are seeing that a lot of countries are again raising their Fed rate, and the United States very well could be the next one, because he did allude to the fact that we're going to see 2 more Fed rate hikes of 25 bips, or we can just rip off the Band-Aid, do 50 bips in July, and then sit and pause for the rest of the year. Right? He's waiting for that inflation to come down. So this, the dot plot is really showing you, so this was last month's, or last times from March of 2023, and this is June of 2023, so a couple months ago. So the majority of people are raising it a full half a point, saying that we expect the Fed rate to be 5.6. Now remember, this is going to affect your HELOCs. If you've got a HELOC that's still floating, that's on you, because I've been talking about locking that in for a year now. So that HELOC is going to go up again. Credit card debt is going to go up again. Interest rates on credit card debt, car loan interest rates are going up, personal loans, business loans, business reinvestments, all of those are directly impacted. I mean, we're seeing a ton of if you read any articles about the real estate market the bottom falling out,
Mhm.
it's the commercial market,
Mhm.
right? Because the commercial market, you have a lot of 5 and 7 year balloons, and those landlords can't afford to refinance because the interest rate's way higher than it was the last time they refinanced. So banks are repoing. In fact, I was just reading an article this morning about a research company that went in and bought an empty DTC office for $4 million or $5 million, $5 million.
Okay.
Vacant, 100% vacant.
Wow.
That's the problem that we're going to have. A lot of people are working from home, they're downsizing, they're shifting, they're consolidating. So the commercial market is really seeing a struggle. The residential market, not as much, because we still have this fantastic generation coming, this Gen Z who gets home ownership. So interestingly enough, we're going to talk about this in a minute, our agenting nights that we're going back to, where 1 week a month, we're going to be in person, which I'm really excited about.
When's that next one?
The last Thursday of the month.
Okay.
So 1 week a month, and we're not going to do it on Zoom, and we're not going to do it on Facebook Live. Now we'll send out the recordings later in the day, but we really are holding that to an in-person. We want to social gather. We want to give hugs, and we want to build relationship, because this is the kind of market where we need to do this. And we're bringing in some phenomenal speakers, but we actually have a speaker that we had at the next big thing talking about how do you communicate and sell to a Gen Zer, right?
That's
so
great.
Kristen Messerly is going to be our special guest, not this month, but she's coming in, what are we in? June, July, August. She's coming in August.
Okay.
All right, so here we go. So we're thinking that it's going to raise, and this is 2023. There's nobody that thinks that we're going to drop. Here's 5.1, which is what we have now. There's not a single Fed member, including Powell, that thinks that we're going to see a drop anymore. Now, the market actually started celebrating again this morning because they were thinking, well, Powell is talking really out of both sides of his mouth. We really do think that if we see jobless claims continue to spike like they did this morning, which I'll show you in a minute, then we could see that Fed Chair Powell changes direction and starts to drop the Fed rate. I don't know. Like, I don't see it. I think that he'll stop. He'll pause for the rest of the year as a possibility, not raising it to 5.6, but there's not a single member of the Fed panel that thinks that we're going to drop rates in 2023 anymore. Now, if you looked at this dot plot from December of last year, totally different. And the same for 2024. They think that it's not going to fall as fast, and then it's going to start to normalize in 2025. PPI came out the day after, right? So PPI came out on Wednesday when Fed Chair Powell had his speak, but the day after the CPI, and it dropped again, exactly the same thing as the CPI. The headline dropped from 2.3 to 1.1. Phenomenal. The market celebrates for a hot minute, and then it goes, oh shit, core didn't do that. Core only dropped from 3.2 to 2.8, and its month over month is again staying sticky. So the market's rebounded again. We've had a very volatile yet very flat week when it comes to interest rates overall. We certainly didn't get the push that we were hoping if we saw CPI drop substantially. Initial claims broke out now twice. I showed this chart last week where we broke out to here, and now we're way up here. This is the 4-week trend line, the red line. So this kind of breakout, if we see 4 more weeks of this, 5 more weeks of this before the next Fed meeting, we could see him hold on to that pause, right? If we don't, and this breaks back down, then we're probably going to see that quarter raise that he's talking about. So we're really watching every Thursday morning. Of course, we'll be talking about it, the initial jobless claims. This is the market mover right here. If I was going to show you only one report and call this time together done, it would be this one over the next 5-6 weeks. All right, retail sales. So there was this, all over the headlines, retail sales are up, and they are 0.4, but we're actually down from last week, 0.3. So we're actually down from last month slightly. So this is kind of hard to read or kind of hard to see, but here's the 0 line right underneath this blue line. So we're up, but just barely. We're down from last month, just barely up. I have to go back to pre-COVID to get a good month this low. So what I'm talking about is sales are down. Sales are down. They're just slightly above 0, right? So people want to celebrate that. Well, consumers are resilient, and we are extremely resilient, but we've been spending out our credit cards. And when our credit cards are done and we've hit our limit and they're not going to raise it like they did the debt ceiling, then we're done. Then we're going to start slowing down our spending, right? And this is what's happening. We're spending, but we're slowing that down. We're pulling it back. And 85% of this is still online. That's a big, big number. So, again, towards that business, right? Those small businesses, the commercial properties are going to feel some of the brunt in this because they're not seeing that sale as much. All right. Then the other one, 2 manufacturing reports came out this morning. So some of the headlines we're talking about manufacturing was up. Some of the headlines are talking about manufacturing is down. The Philly manufacturing report is focused around Philadelphia, the New York, around New York City, and they're talking about what their manufacturing output is regionally. So New York is up, but just barely, and Philadelphia is down worse. Really, we're only going to be looking at the PMI reports at the end of the month. So I'm going to hold off on saying that this dictates or tells us anything right now, other than the fact that we're a services country, and I'm just going to ignore manufacturing for right now. If people aren't buying, people aren't having to build. All right. We've got to stay in flow. How are you communicating? How are you educating? How are you standing beside your client, even when they're in fear? I want to show you some tools. So we talked about this the last couple of weeks about bringing in some tools that you can use where you can stay in flow and just support that client. And we have so many more than the couple that I just want to show you, but I want to show you some of the things that are available. So of course, we do a ton of content. This every Wednesday. If you're not getting our emails, you should be. On Wednesday, we talked about 3 ways that you can afford more home. And we put that out in a quick little video, and we shot that out to both real estate agents and clients. So through one of our tools that we have access to, we have a buy versus rent tool. So looking at the fact that if I was looking to buy a $600,000 home, or I was looking to rent something that I could buy for $600,000, at what point does it make sense? Because right now it's more affordable to rent. Mm-hmm. Right? It just is. Mm-hmm. So how soon does that flip over? So this shows you that you break even at year 3. So if you're going to sell within the first 2 years, don't buy, rent. But very quickly, that gain of appreciation and that principal reduction is going to add up fast. Add to that the tax advantages and the fact that you can do what you want to it, the fact that you can sell it, the fact that you can rent it out and hold on to it and have rental income. Mm-hmm. I mean, I could just go on and on and on, right? We need to make that a whole hour conversation, why you should buy and not rent. But having this and being able to provide it to your clients who want to sign another year lease because it costs more now to buy than rent, let them know that if we continue to see prices increase when rates do come down, it's going to even be more in against them when they have to pay even more for that home. The other thing is the bid versus ask. On those homes that are priced right and staged right, they're going for over, right? But then again, you just saw some that are dropping their prices. So depending on what home you can get, and if it's the perfect home and it has more than one offer on it, people are thinking, but there's another home down the street that doesn't have any offers. I should be able to get a better price on this home that has multiple offers. We have to maintain perspective. Some homes are going for over and other homes aren't in this crazy market, right? Yep. So how do you convince them of that when they're hearing that we might have a bubble, when prices might go down, but this is the home that I really want? So this bid over ask tool is coming back out again. It was we used it a lot during the massive period of time during COVID. Now we're pulling it back up again to show really when do you break even from that? And at what point does it start to benefit you to go ahead and get in today and start gaining that uptick in appreciation. So it is really fascinating to show how quickly you gain back any overage you do pay. And all of these, I added Robert, the last one I had Lindsay, we can co-brand all of these. The temporary buy down calculator, I put this on social media. You guys need to have this in your toolbox, because if you're negotiating with a seller to buy down the interest rate right now, when we think interest rates are going to go down next year, it could really benefit you. Even if you did a 1-0 buy down just for 1 year, what is this going to save my client on a monthly basis if I use the seller credit to buy down that interest rate on a temporary basis? To have those numbers, to be able to negotiate intelligently and be able to work with the numbers that Megan gives you as to what is the average reduction that sellers are seeing, and then tie that into closing costs and a buy down. I mean, that's a winning edge, right? Yes, that's a winning edge. All right. And then one of my favorite tools that we hand out every single month is the Building Wealth Through Real Estate model, where you can actually put in your investments. I sat down, gosh, I don't even know, what's today, Thursday? So earlier this week with a number of real estate agents. You guys have to take care of yourself first. sat down with a number of real estate agents in my office one-on-one talking about how do we take care of your financial future, your stability, stop living from commission check to commission check and start building in that sense of financial stability even when markets are down, right? So how do you do that? What does that look like? And if it's not in Denver, we've got people looking, I got a ton of people looking in Tennessee right now. What is up? It's crazy, but it's popping. Tennessee's popping, another one in Ohio. The Carolinas, yes,
Carolinas are popping.
North Carolina right now. And then in Wyoming. So you guys, we have access to all 50 states. I'm licensed in 36 states. This is the opportunity. And the reason I do it is for our real estate agents and for our investor clients who, if not Denver, then where? So getting you into the right place. And we only give this away to people who come to our Building Investment Empire class, which happens to be tonight. And if you didn't make the parade and you want to come celebrate, we got chicken nuggets.
Chicken nuggets.
We're celebrating with
what
chicken.
kind of dipping sauce do you have?
All the dipping
All
sauce.
the dipping sauce. Now, where are the nuggets from? Is it like McDonald's or Chick-fil-A?
Chick-fil-A.
Chick-fil-A. All right.
So chicken nuggets, and we've got nuggets giveaways. So really excited about that. We've got some nuggets giveaways for the Nuggets fans. So want to make sure that we're just continuing the celebration. You were at the parade. You should come join us. While you're staying in flow, one of the things that we're offering all of our clients is we don't do hard pulls in the beginning. We do soft pulls. So we want to make sure that we're giving you the advice, we're reviewing your credit, we're creating the strategy, and we're putting you on a plan. If not now, let's set you up. I'm not the kind of lender that needs to close your deal in the next 30 days. I'm the kind of lender that wants to stand beside you for the next year while your buyers are figuring out when is the best time to jump in. Now, none of us want it to wait a year, but when it does, do you have somebody that's going to stay in flow and help that buyer put themselves in a better position when the time is right? And we do that with the soft pulls and the credit advice and the what ifs and the credit support that we provide. Plus, we're going to waive all the lender fees. If you do refinance when rates come down, we're going to waive that lender fee. And we make sure that all of the folks that came through us the first time are going to get that. Matter of fact, and I just upped this to 2025. I had it at 2024 because I thought we'd see lower rates. I was really hoping.
Oh,
but
man.
You know what? I don't care. I'll just keep pushing out. I don't think I'll have to. I think it's going to happen in 2024. And then this is the thing, right? So the last Thursday of this month, Megan and I cannot wait to see you in person. We've got Eric Thompson. We've got Justin Knoll. They coach agents across the country, top performers, and how are they crafting their edge to get more clients, if not under contract, in flow, in their database? How are they working their markets? And last, all right. I know.
This is like 10 slides of promo.
It is 10 slides. You guys thinking about, it was a little promo, but I'm really trying to have you guys forget about me for a second. How can you do all these things? What's your book that you're going after your database and communicating in a different way, right? Like, because you can't keep doing the same thing that you've always been doing and reach out to those clients. So if you want to have an investment conversation, but you want it to be a smaller group, then we can do that too. So it's really about crafting the message specific to your database and sharpening your edge, right? Like, I love how you provide all of the data for all of the different markets, right? So if you guys work 3 different markets, you should have a different set of book and materials for each one of those markets, right? Or a different strategy. You guys got to think outside the box. Yeah, I'm saying.
I'm working just as hard now as when I first got
into the
industry.
I'm working harder.
Yeah.
I'm working so much harder. All right. So what's the best deal on an ARM? ARMs are tough. So if you're really doing an ARM, it's probably going to be a portfolio bank type of an ARM scenario. Freddie's and Fannie's don't love ARMs. When we get into the jumbos, we're doing more ARMs. But it's so specific on how much money you're putting down in your credit score.
This is a long question. I feel like the consistent topic for the past decade is that people are waiting for something to change. It was the price conversation until interest rates began to rise last year. Now folks are waiting for interest rates to drop to get into the market. All along, we've been in a supply-demand crunch that doesn't appear to be changing anytime soon. Point, what are you waiting for? Plan, get smart with your spending, connect with Nicole, and do the dang thing.
Do the dang thing.
All right.
Yeah, it is going to be something. Down 23 from, down 23,000 from what point? A year ago. Yep.
Colorado was down 23K based on the national home ownership equity. Since when? January, year over year, since 2022.
Year over year.
Do we have any historical data equivalent to project the impact of student loan payments restarting around September? I just read an article with anecdotal data about the number of people who saved up for a down payment with the loan repayment pause and become homeowners, or who started families through being able to afford IVF.
Yeah.
Okay.
Love that.
Who's likely to end up underwater, or what are potential opportunities to support home buying?
That's a tough one to know, because many of those people probably don't own homes yet, right? So if they have been saving up and they've got a better down payment because they didn't have to pay the student loans, now they're in the home, and yes, their payments have been going up, but I hope that they've been taking that into consideration when they bought the home, that they had all these student loans that were going to come due at some point, right? $100,000 of student loans isn't going to go away. So that conversation should have been had before they buy. But a lot of them, I don't feel, are homeowners yet. And it might pull back some of those Gen Zers or millennials.
Is a 1-0 buying down 1.4 a year?
No, the 1-0 means 1 year. So you have a 1-0 or 2-1 buy down or 3. So the 1-0 just means that you're buying it down. Oh, I see what you're saying. By 1%. So if the interest rate right now is 6.75, your interest rate for the first year would be 5.75, and then it would go back up to 6.75 the second year.
Awesome.
Yeah.
Well, that takes us through. You want to wrap us up?
Guys, right?
Guys.
There's so many. I mean, yes, there was the economics, all the stats, the promo material, all of it with the hyper focus of conversations are so easy to have right now. So you could get all buried in a hole about the instability or insecurity or the fear, or you could come through and be the guiding light, be the thing that they know you're the expert that deeply cares. Going back to be good and do good. Right? Are you the one that they know has their back? And then all of that, are you communicating? Are you finding different ways? Are you creating classes and content? Are you reaching out to them in that process? And that's why we're here. That's what we love doing, is giving you this content, the events, gosh, all the things.
We like to do all the data.
Yes.
All the things.
If we can help in any way, we will. Megan has answered emails. You shut down with the kids. I am on way too often. If you have questions, you need graphs, you need charts, you need ideas for classes, you need ideas for marketing materials, give us a call. We are here to support you. And in turn, we hope to see you at your closing table. That is our goal. Nicole Ruth, Megan Aller, we hope that you have a fantastic week. We hope to support you with your clients, and we'll talk to you very soon.
We'll see you soon. Bye, guys.